Welcome to this explainer. Today, we're cutting straight through all the noise to break down the actual, mathematical realities of building wealth. We're going to look at the exact mechanics of how money actually compounds, how it's lost, and the invisible forces that dictate the entire financial world.
You know, most of the financial advice floating around out there is really just designed to sell you a product. It leaves you with this overwhelming wall of noise and rules of thumb that sound good but don't hold up. We are going to strip all of that away today. We'll contrast those popular myths you've likely heard with the concrete, step-by-step math that actually determines your net worth.
All right, let's kick things off with Section 1, the optimal financial sequence. We need to nail down this foundational structure before you even think about picking a single stock or asset.
Think of this sequence as your ultimate blueprint. Notice step 1 right there, a $1,000 starter emergency fund. This is literally your firewall so you don't end up having to liquidate investments just because your car breaks down. Step 2, capture your employer match. Guys, that is an instant, guaranteed 50 to 100% return. You mathematically cannot beat that. Then, you've got to kill the high interest debt. Wiping out a 20% credit card balance mathematically destroys any stock market run you could ever chase. And only after all that do you move to maxing out a Roth IRA. Nailing this exact sequence literally dictates whether your money is working for you or against you.
Moving on to Section 2, the real math of assets and taxes. You see, the actual vehicles you use to hold your investments dramatically change your retained wealth. Because at the end of the day, it's not just about what you earn, it's about what the government actually lets you keep.
To see this in action, let's look at Maya and James. They're the exact same age, have the same salary, and they invest the exact same amount over 35 years into the exact same index fund. They both end up with a balance of roughly $816,000. But here is the kicker. James chose a Roth IRA, which totally shields his growth. So while Maya is paying about $9,000 a year in taxes during her 25-year retirement, James, he pays absolutely zero. That choice alone saves him $225,000. The math here is undeniable. Paying taxes today at a known rate often shields you from a massive, unpredictable tax burden tomorrow.
And speaking of the real math, let's talk about housing. Conventional wisdom always tells us to spend 28% of our income on housing. But man, when you actually factor in all the real costs, that rule is completely broken today. A $280,000 mortgage might look like $1,863 a month on paper. But when you add in property taxes, insurance, private mortgage insurance, and just a conservative maintenance budget, your actual out-of-pocket cost skyrockets to over $2,700. The banks might gloss over all those extra line items, but I promise you, your checking account won't.
Now, let's look at how completely different assets function in the real world. Say Jake puts 50 grand into a rental property and Marcus puts 50 grand into physical gold. Jake's real estate acts like a high-maintenance machine, multiplying his equity through leverage. After 20 years, he's sitting on a $460,000 position. But hey, he traded a lot of weekends and probably a lot of his sanity to get there. Marcus's gold, on the other hand, simply acts as non-producing armor against inflation. He ends up with about $182,000 after taxes, but he did absolutely zero work. It's a great reminder that these are completely different tools designed for completely different jobs.
To truly understand Jake's real estate success and his massive risks, we really need to talk about leverage. It's the ultimate financial amplifier, and it works intensely in both directions. Leverage is the exact reason real estate can build massive wealth, but it's also the trapdoor that ruins people. It just multiplies everything. So here is the absolutely crucial point. A 10% drop in an unleveraged asset? That's annoying, but it's totally survivable. But if you only put 10% down on a house and the property value drops by that same 10%, boom, that completely wipes out your equity. You literally lose 100% of your money. Leverage doesn't care which way the market is moving, it just makes the movement happen much, much faster.
All right, let's shift gears to Section 3, index funds and timing. We're going to look at how this builds into the actual engine of growth by exploring how the stock market multiplies your money, assuming you don't interrupt it. Get this, between 1926 and 2019, exactly 4% of stocks accounted for all the net wealth creation in the entire U.S. stock market. Seriously, let that sink in for a second. The other 96% of stocks collectively performed about as well as boring government treasury bills. What does this mean? It means if you're out there trying to pick individual stocks, you are overwhelmingly likely to pick a loser. And because picking that magic 4% is virtually impossible, owning the whole index guarantees you actually hold the winners. This is the ultimate undeniable argument for index funds. But a quick reality check here.
Owning the S&P 500 today also concentrates your risk. The top 10 mega-cap tech stocks currently make up roughly 35% of the entire index. It's an incredible wealth builder, no doubt, but it does rely heavily on a few massive winners pulling the rest of the market up with them.
Now let's talk about market timing, which plays out super counterintuitively. Imagine two investors. Bridget unluckily invests her money at every single all-time high right before a drop, while Wendy waits patiently in cash for a 10% dip. Historically speaking, Bridget actually vastly outperforms Wendy. Why? Because while Wendy is sitting on the sidelines in cash, she misses out on compounding, she misses dividends, and she misses those massive unexpected market rallies. Time in the market mathematically beats trying to perfectly time the market, pretty much every single time.
This brings us to Section 4, Taxes, Bubbles, and Survival. We've covered the personal finance side, but now we really must escalate to the macro forces, the things that can destroy decades of your hard-earned compounding practically overnight.
So, why does almost no one understand bonds? Well, it's a $130 trillion question. The bond market is basically the invisible engine of global finance. It dictates interest rates and the stability of entire economies. Think about it. When bond yields rise, mortgages suddenly get more expensive, business slows down, and stocks have to quickly reevaluate. If you don't understand bonds, you simply don't understand how money moves on a global scale.
And a huge part of that is the yield curve. When the yield curve inverts, it essentially means investors are panic buying long-term safety. Short-term bonds suddenly start paying more than long-term bonds. This is a massive, flashing warning light on the economic dashboard, and it has preceded every single U.S. recession since 1955. It is literally the bond market screaming to the world that trouble is on the horizon.
And these macroeconomic shifts, they are exactly what pop bubbles, just like the notorious dot-com mania. An investor who bought at the absolute peak of the NASDAQ in March of 2000 had to wait 15 full years just to get back to break even. And that wasn't because they bought bad companies. I mean, the internet really did change the world, right? But they suffered because they paid a price that was completely disconnected from mathematical reality.
Which perfectly highlights the math of survival. You have to remember these fundamental laws. Time compounds harder than money does. Equity makes you free. But above all else, never let your compounding multiply by zero. Think about the math here. If you lose 50% of your portfolio, you don't just need 50% to recover. You need 100% return just to get back to the exact spot you started. That's why your absolute primary job as an investor is always protecting the downside. Financial manias happen precisely when we forget this math. It perfectly mirrors John Maynard Keynes' famous beauty contest analogy. In a bubble, rational people completely stop asking, hey, what is this asset actually worth? And they start asking, what will someone else pay for this tomorrow? We stop evaluating the actual value and just try to guess what the crowd is going to do next.
So, as we wrap up this explainer, I want to leave you with a crucial thought to ponder on your own wealth journey. The next time you feel swept up in a financial frenzy, ask yourself, are you making decisions based on the real, undeniable math, or are you just blindly following a crowd? Because understanding the actual math, well, that's the only proven way to survive the cycle.